A very good morning to you, all of you students. So today we will resume with our topic where we left on the interest rate risk management. So in the previous session, we studied about the techniques of managing interest rate risk. In that, we studied about asset liability management, ALM. Then we also studied about FRA, which is forward rate agreement. Then at last, we studied about interest rate futures, how to do the interest rate risk management using bonds market. So let's start today with the fresh topic, which is interest rate options. So this was the fourth technique. And we also said that these are also called as guarantees. Interest rate options slash guarantees. Okay. Now to understand this, we are just trying to draw some similarity between what we studied in our derivatives topic. As I told you that forwards, futures and options, these three instruments we have studied there. So forwards is more likely to be forward rate agreement that we have already studied. If I say forwards is equal to FRA, futures that we had studied is equal to IRF, interest rate futures, and options. The third instrument is mostly equal to this interest rate options slash guarantee. Okay. So just to elaborate it further, let's focus on this contract. So here I have A is mentioned as a contract or it is a right. So please understand this A is a contract itself. It is not a party. It is nothing to do with anything else. It is just simply a contract which has a right or it has a privilege. But it's not an obligation. There is no obligation. The only obligation under this contract is to pay the premium. That's all. There is no other obligation under this contract. Rest all are our rights, whosoever is having this contract. So if we say that this A is a contract which has certain rights for us, but no obligations, that is what is our subject matter to study in the interest rate options. So the general features of these are rights, but not an obligation. There is no obligating event. Whatever benefits I have under this contract, I only have rights. And as I told you that only obligation is to pay the premium, and the premium payment also happens generally at the start of the contract. Just a second, students. There is some issue with my writing, but just a second. Yes. So, yeah. So we were discussing that these interest rate options are rights but not an obligation. And as I told you that obligation also exists only at the entering, only at the time of entering the contract. That is pay the premium. That's all. Then there are some conditions which will lead to the exercise of this option or which will lead to non-exercise of this option. Those are maybe favorable conditions or non-favorable conditions that we will try to understand how it happens. So can be exercised under favorable conditions. Need not be exercised under unfavorable conditions. Again, reflecting back on your knowledge of derivatives, there were two types of options that you studied, call option and put option. So the call option, if the price of the underlying goes more than the strike price, then only you will exercise your call option. So that is what I'm trying to tell here. If the conditions are favorable, for example, the price has gone up, in that case, your contract becomes favorable to you because it is helping you to purchase something at a strike price, which is not there in the market. So hence it can be exercised during those conditions. And if the situations are unfavorable, the conditions are unfavorable, it will not be exercised. Sorry. So we were on to this, we were trying to explain through this simple chart is if let's say A is a contract which has only rights and no obligations, and contract of what? Contract to borrow. To borrow means to take money on credit. This is a contract to borrow specified amount. The amount would be specified. For example, it's a notional amount. Let's say 1 lakh rupees, 2 lakh rupees. So definitely when I will say that there is a contract which allows me to borrow, I will have to specify the amount in that, correct? So this is called as notional amount. To borrow specified amount, which is as good as notional amount at specified interest rate. All these terms and conditions are part of the contract, that how much would be borrowed, at what rate it would be borrowed. Let's say A is a contract to borrow 1 lakh rupees at 6% per annum. Okay. And when it will be borrowed, it will answer my third question. What amount to be borrowed, at what rate it would be borrowed, and when it would be borrowed. So the third condition is on a specified date. So on this specified date, what amount needs to be borrowed at what rate? This is my cap option. This is called as cap option. Why this is called as cap option? Because this help using this contract, I can actually limit my percentage, or let's say the interest, to this amount. I need not pay anything more than that. If tomorrow the market interest rate goes more than the specified interest rate, I will exercise this option and take the benefit of this option. So that this is the cap rate. Whatever interest rate is specified here, my actual interest obligation would not be more than this. Okay. We will understand this better through some of the examples. So just like a normal call option. So this is just like a call option equivalent. Okay. This cap option is nothing but the call option equivalent. So the cap option would also have a buyer and it would also have a seller. Generally, seller would be a bank, correct? It would depend. So there is a seller and there is a buyer. Seller will receive the premium, buyer will pay the premium, because for this, there is a premium involved as well. For cap option, there will be a premium because the seller is actually undertaking, is actually giving you a guarantee that he or she will make it this, will lend the amount to you at the specified interest rate. So that's why seller would seek some form of compensation in the form of premium. Now this is first that we need to understand. Let's go to the second one. Now again, assume A is just like above, it's a contract with right and privileges, but no obligation. Again, there is no obligation, but here the contract is to lend or to invest. So the contract is to lend or to invest. That is what is specified in the contract. What needs to be lent or invested? A specified amount. Correct? The amount needs to be specified, that how much needs to be lent or invested. Again, at a specified interest rate, because that interest rate would also get specified here. Because we don't know tomorrow what is the interest rate. Hence, this contract says that the lending amount would be invested at this much percentage on a specified date. Everything is similar to what we have seen in the first option. So in a way, this contract, the second contract that I've mentioned, is giving the holder of this contract a guarantee that minimum this percentage of interest they will get. Hence, it is called as floor option, because it is helping to determine that at least this much you will get. Similarly, here we studied that it's a cap option, because the first part of this contract, I mean this entire contract of A in this is helping the holder of this option to cap the rate. Correct? Because if the rate moves further up against this specified rate, then A will be exercised by the holder of the contract. Similarly here, if the percentage goes down, then the specified interest rate, because here the person is investing. While I would invest, I would want the maximum returns. So if the percentage of interest goes below the specified interest rate, then this A will be exercised. Okay, students? So Kaushiki is saying that in both borrower has a long position. I would say, Kaushiki, in this case, yes, borrower has a long position, because borrower in itself is entering into a cap option, and anything which goes up, they will get benefited. In this case, I would say that borrower has, because the holder of the contract, if you see, and this is the seller of the contract, I can say this is also buyer. Correct? So the holder or buyer, whosoever is the person, he is seeing it from the lending perspective. But the seller, who would again be, let's say, the borrower in this case, is seeing it again from the giving some sort of a guarantee. Okay. So from borrower's perspective, if you see, tomorrow if the interest rate goes up, for this contract, I'm saying, the buyer or the holder will not exercise this option. Why? Because this option will only be exercised once the interest rate goes down. Correct? So borrower will not have any implication in case the interest rate goes up. Only to the fact that borrower has to pay the actual interest rate, whatever it is. Yes, Kaushiki, you are right. Lender 2 has the, in case 2, lender 2 has the long. Now this is the right understanding. Okay. Now let's try to understand it through some figures. As I told you that there is a premium also that will be charged by the seller or whosoever is writing the contract. Correct? So we cannot ignore this, and this will be paid by the buyer, received by seller. We're talking about premium, because premium is the amount that will be paid or given to compensate the other party for assuming the risk. Now let's see this. Yeah. So let's talk about, this is cap option. This is floor option. And we are talking it from the perspective of holder, or let's say buyer. So buyer of cap option has a right to borrow. Right to borrow. The holder or the buyer of floor option has a right to sell. Not right to sell, but right to invest. Right to sell is in the put option, correct? In derivatives. So this is the right to invest. Okay. Now let's say 10% is the cap rate. And here also 10% is the floor rate. This is nothing but the strike price. This is also strike price. Okay, students. So I'm assuming this some numbers so that we can understand it better. Now, the actual interest rate on the interest date reset, or let's say on that specified date, whatever is specified in the options in the contract, turns out to be 12%. In such a case, what will happen? Now think it from the holder of cap options perspective. What he or she will think is that I have an option to borrow at 10%, and at the same time market is charging me 12% as the actual interest rate. So don't you think that he will be happy, the holder of cap option will be happy, because he or she will say is that I have a right to borrow at a lower interest rate at 10%. So this is a favorable condition to me and I will exercise this. So gain/loss in option Here it will be plus 2%. Correct? If the interest rate is 12%, it will lead to gain of 2%. This is gain. Now, what if actual interest rate is actually 8%? Now, students, what will happen here? If the actual interest rate is 8%, what will the holder of cap option think? The holder of cap option will say that I have a right to borrow at 10%. And at the same time, market is offering me 8%. So I will go and exercise the market interest rate at 8% and I will borrow at 8%. So the condition of this option becomes unfavorable to me. I will not exercise the option. Gain/loss in option in this case. So this is first case and this is second case. In this case, it will be 0%. NA, which is not applicable. I mean, the contract will not be taken out at all. Okay. Now comes the floor option. Let's understand it from the floor option. Now, floor option gives the holder the right to invest. The right to invest at 10%, which is the floor rate. Let's say it's the strike price. So 12% is the actual interest rate percent that comes out to be. Now think from the holder of this floor option. The holder of floor option will say that I have a right to invest at 10% under the contract, but market is offering me 12% on my investments. So I will not do anything with this. Correct? Because I will just go in the market and invest at 12%. There is no obligation to me. There is no obligation to me to compensate for 2% because it's not an obligation, it's a right. If the conditions are favorable, I will exercise. If it's not favorable, I will not exercise. Then case 2, we assume that it is 8%. Now think again what the option holder of floor option will think. I have a right to invest at 10%. Correct? I have a right to invest at 10%, but the market is giving me only 8%. So don't you think he will be happy because 2% would be the gain in this particular case? Because he will then exercise his option to maintain the interest rate at 10%. Now, ultimately, what will happen? Final cash flows percentage. So in situation 1 and situation 2, so situation 1, in market, it will pay 12% and it will get a gain of 2%. So net it is 10%. Correct? The cap option holder will ultimately end up spending 10% in the form of interest. Because 12% he will pay in market, 2% he will receive as an income on the option, and ultimately 10% would be the interest rate. In the second case, it would be 8% because ultimately 8%, nothing is payable, receivable under the contract. And of course, the premium, because premium is there in all the cases, and hence I am not assuming it because for comparing, it is not feasible to take premium. In option 1 here, the investment will happen at 10%, which is under the, the investment will happen at 12%. Correct? And in this case, 8% plus 2% is equal to 10%. So students, if you see, ultimately what this option has done is, it has given them a guarantee. Correct? To the First, to the cap option holder, guarantee is that the maximum cap on your borrowings will always be 10%. This is the cap. And to the floor option holder, the floor rate to earn interest is this 10%. So your earning will never go below this. Yes, Kaushiki, you are right. In floor first case, not exercise. Perfect. Case to floor case exercise. Yes. Okay, students, I hope it is clear. All of you can note it down. So as I mentioned that this is the floor option and this is the floor price and this is the cap price. This is what the entire agreement has done. Perfect. So let's come to this question. Question number 5. XYZ Limited borrows euro 15 million of 6 months LIBOR plus 10% for a period of 24 months. So what they're saying is they're taking the benchmark of 6 months LIBOR and plus 10% is the spread that they are putting for the purpose of borrowing for 24 months. The company anticipates a rise in LIBOR. This is a floating rate linked borrowing, right? Because the rate will float and hence the borrowing percentage, the interest percentage will also change. The company anticipates a rise in LIBOR and hence it proposes to buy a cap option from its bankers at the strike rate of 8%. This is clear? So the strike rate, the cap rate is 8%. The lump sum premium is 1% for the entire reset periods and the fixed rate of interest is 7% per annum. The actual position of LIBOR during the forthcoming reset period is 1, 2, 3, 9, 9.5 and 10. So against LIBOR, we have agreed the strike rate of 8%. So again, this 9, 8% will be there, again 8 and again 8 during the different reset periods. Okay. You're required to show how far interest rate risk is hedged through cap option. For calculation, work out figures at each stage up to 4 decimal and amount nearest to pound should be part of the working notes. So we can say that amount, first of all, required is equal to 15 million pounds. Cap option is actually 8% against LIBOR. So students, please note that it is specifically mentioned in the question that it's against the LIBOR, 8% will be the cap option. And I am just putting an assumption here. I'm assuming that there are 4 reset periods. Although the data is only given for 3 reset periods, correct? But since question is also specifying 6 months LIBOR, so it is safe to assume that there are 4 reset period of 6 months each, because it is for 24 months, right? Alternatively, you can also assume 8 into 3 because 3 reset periods data is given, correct? But I am actually taking 4 reset periods because evidently it is given in the question. It's a 6 months LIBOR. So that means it is up. So 6 months LIBOR, then it will again get reset. Then again it will get reset after 6 months. So the resetting is happening after every 6 months. Okay, so these are the 4 reset periods. First of all, let's calculate the total premium. For 4 reset periods, the premium is 15 million multiplied by 1%, correct? Notional amount multiplied by 1%, that is around 15,000 pounds. Now, this 15,000 pounds, sorry, it's 1,50,000. It would be 1,50,000. So this 1,50,000 is the amount as on 0th period. Now the question is asking us to calculate the net impact on each reset date. So can we express this 150? What will be the amount at 1, 2, 3, 4 in equal installments? Like we can calculate EMI of this amount, which is 150. Yes. Let us assume that as X. Correct? So we want the equated amount for this 150 over all our reset periods, because that will help us in doing the proper comparison. So if we assume that, then just see this formula, you will be able to understand. So what I have done is I have just calculated the present value of X of all the 4X, right? And equated it 150. And why I have taken 7%? Because this is the fixed interest rate given in the question number 1. So this fixed interest rate is used to take the present value of this equated amount, and raised to the power 1 will be the period. So let's say 1 period, 2 period, 3 period, and 4 period. This is just the simply present value and future value concepts. So if you solve this, then the X will be 40,881. So ultimately 4881, 4881, 48, sorry, it should be 861. Okay, so this 4861 is the amount that is coming as an equated amount. And if we sum this after taking the present value, it will be equal to 1,50,000. Now we have the equivalent amount of cash flow for 150,000 at 4861. We can easily calculate the net payoff. Calculation of net payoff. Reset period 1. What is the LIBOR at this period? 9%. Cap rate 8%. Difference from bank that we are going to receive, correct? Because in this case, we would be receiving from bank, which is 1% on 15 million pounds multiplied by 6 months, correct? Because I'm assuming that reset period is of 6 months. So for the next 6 months, there will be a benefit of 75,000 pounds. What is the premium that we have paid? Because premium is a cost, correct? 4861 net payoff we will receive is 75,000 minus 4861, which is 34,139. So Namrita is saying to explain this formula again. So Namrita, this is the present value annuity factor related formula in which the concept is we are trying to calculate one equated amount, the present value of which would be equal to 1,50,000. Now, for example, you take a home loan. The EMI is fixed, correct? The amount is fixed for the EMI, which is, let's say, 40,000 per month. However, if you take the present value of all those amounts, it will be equal to the housing loan. So we are trying to calculate that equated amount through this formula. Now, how we will do? Let's assume X, because if it is an equated amount, it will remain constant at all the 4 reset periods. And then for each and every time, let's calculate the present value. So here the present value will be for 6 months. Here the present value for 2 years. Similarly for not 2 years, 2 periods, then 3 periods, then 4 periods, like that. And 1 period is for 6 months. Hence, we have taken an interest per annum divided by 2 to arrive at the 6 monthly applicable interest rates. Correct? 7% by 2. And then raised to the power the number of reset periods. Okay? Then second reset period, LIBOR is given as 9.5%. 8% is the cap rate. This remains same. 1.5% would be the payout for next 6 months, which is 1,12,500 bonds. 4861 remains same as premium. So hence it becomes 71,639 as the net payoff. For third reset period, interest rate is 10%. 8% is the cap. 2% multiplied by 15 multiplied by 6 by 12 again, we will have to do. This brings us to 1,50,000 equivalent of bonds. 4861 is the premium payoff that we can use to compare. 109,139 is the net payoff. So if we total the entire amount, it becomes as 214,917. So the extent by which interest option have hedged the risk is bond 214,917. Reset period 4 we can ignore. Reset period 4 we can ignore because anyways only 3 reset periods are given. So Kaushiki, we can ignore that. Good morning, Sanjay. Is this clear? I think the overall topic is very easy. It's just to understand and just to relate it back to what we have studied in the derivatives. Then it will become very easy for us. Let's come to this question, which is again a very good question. Two companies, ABC Limited and XYZ Limited, approach DEF Bank for forward rate agreement. They want to borrow a sum of rupees 100 crores after 2 years for a period of 1 year. Okay. What they are saying is FRA, they are standing today. After 2 years, they want to borrow for 1 year. Duration is 1 year. So FRA is 2/3. Okay. Bank has calculated yield curve of both the companies. Now see students, yield curve all of you know. In our previous session, we covered what is yield curve. Yield curve is yield on y-axis and maturity on x-axis. And as the maturity increases, the yield also increases. The same thing is evident here. So if XYZ Limited wants to borrow from DEF Bank Limited for 1 year, the applicable interest rate will be this. If XYZ Limited wants to borrow from DEF for 2 years, the applicable interest rate would be this. Okay. So it's like that. But if you see between XYZ and ABC, ABC is being charged premium. ABC is having higher interest rates. 3.86, 4.12, 4.2, 5.48, 4.48, 5.78. It is significantly higher. Why it is higher is also given. The difference in yield curve is due to the lower credit rating of ABC Limited. Higher risk, higher reward. As we have seen in my opening part of the previous session, I clearly told that interest is function of two things. One is risk, which is governed by credit rating agencies. Second is time value of money. Correct? Risk of non-payment we discussed here. This is the risk of non-payment. So the same thing is clearly told here that why ABC Limited is being charged higher interest because of higher risk of non-payment as credit rating is slow. I mean, credit rating is low. Okay. I hope you are able to link it. Now, the requirement is you're required to calculate the rate of interest DEF Bank would quote under 2/3 FRA using the company's yield information as quoted above. So they are first of all asking us to do the pricing of this FRA. What is the value of this FRA, valuation of this FRA? That is a very easy step. Suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. You're required to calculate the interest payable by XYZ Limited. Now, this part is for both XYZ and ABC, but this part is only for XYZ. It is saying that whatever amount comes under first for FRA 2/3, that you take as a strike rate, and on that interest rate guarantee is given, correct? Because interest rate guarantee would be given on the same price. And the premium charge is 0.1%, you are required to calculate the interest payable by XYZ if the interest rate in 2 years turns out to be this or this. Simple. Let's tackle one by one. Let's start with the flow of question. So we can actually take 3 years interest rate and equate it with 2 years interest rate, and this interest rate we can assume to be X, correct? To arrive at the FRA for both. So for XYZ Limited, what is the 3 years interest rate? 1 plus 4.48% raised to the power 3. 1 plus 2 years interest rate is 4.2%. Raised to the power 2, 1 plus X% raised to the power 1. So X comes as 5.04%. This is for 2/3. Okay, students. I hope this is clear. Then for ABC. What is the 3 years rate? 5.78. What is 2 years? 5.48. 1 year? 6.38 percentage is the percentage given by the bank for again 2 by 3 FRA for ABC Limited. Now, the second part of the question says that there is a cap option which would be given at 5.04, correct? Because 5.04 we have calculated it from here. And second option, and the second part is only for XYZ Limited. Premium is already given in the question, 0.1%. Notional amount 100 crores. So there are two cases that are given, 4.5 and 5.5 percentage. First of all, the interest amount we need to take as is, right? This will be 4.5% multiplied by 100 crore multiplied by 1 year, because the borrowing is for 1 year. So 4.5 crores. Here, since there is an option to borrow at 5.04, the actual interest rate is 5.5. So the option will be exercised and hence the cap rate will be leveled. So in this case, 5.04 percentage multiplied by 100 crore for 1 year, which is 5.04 crore. Now, if you see students, although here it should be 5.5 crore, correct? If the cap option would have not been taken, the actual interest would have been 5.5 crore, but it has restricted to 5.04 crore. Premium. Premium would be irrespective whether we exercise or whether we don't exercise, because it is a sunk cost. So 4.5 plus 0.1, it becomes as 4.6 crores. 5.04 plus 0.10, it becomes as 5.14 crores. I hope this is clear, students. Okay, let's go further now. Now, students, we are going to cover swaps, interest rate swaps. So I request all of you to please pay attention to the discussion that we are going to do now, which is for the next at least 15 to 20 minutes, because this will form really the basic of how you understand swaps. Okay. It's not at all difficult. It's very easy. So just be there with me at each and every step and ask any question that interrupts you. Okay. So this is the fifth technique, interest rate swaps. Okay. Now, please focus here. There are two companies, company A, company B. Okay. Company A is actually well established company. It's a relatively new company. This company wants to borrow and company B also wants to borrow. Both of them are in need of funds because company A wants to expand and company B wants to grow. So they need further new investments for which they want to borrow. But company A actually has a risk committee which always says that you have to borrow in floating interest rate only. So they prefer floating. But since company B is low on profitability, they don't have enough EBITDA to fund for the repayment of loan, they prefer fixed percentage loans. So I'm saying prefer floating percentage loans or borrowings. They prefer fixed percentage loans or borrowings. That is the preference that both of them have already given. Okay. Now there are banks also in picture because when it comes to borrowings, how can we complete our discussion without banks? So company A approaches bank A and asks for loan. Bank A says that, okay, I will give you a quote. So company A says that I want floating percentage loan. So you tell me what would be my pricing of the loan. Bank A says that, okay, I'm giving you both options. Whatever you want to take ahead, you can say. So bank A says that fixed coupon. If you take a fixed coupon borrowing, it will be 7% for you because since you are a relatively old company and you have good credit rating, so I'm offering you a fixed coupon of 7% and floating. I am offering you, let's say, LIBOR. Although LIBOR is not there as of now, but I'm just using as a part of my discussion. You can assume it to MIBOR also. It is some sort of a benchmark rate. Okay. So for ease of reference, let me use MIBOR only. Okay. So company A goes to bank A and bank A says to company A's officials that if you want to borrow at fixed rate, I can offer you 7%. If you want to borrow at floating rate, I can offer you at MIBOR. Then similar story with company B. Company B goes to bank B. Bank B is actually under, they have undertaken companies B's credit rating and that is not very good. So they say, they quote somewhat higher pricing. So they say that if you want to borrow in fixed, then you can take it at 10% per annum. But if you want to borrow a floating, then it will be MIBOR plus 1%. So this is the pricing that has been given to company B from bank B. Now, both of them have treasury teams, company A and company B. They are evaluating further that how can they still achieve their objective in taking floating interest for company A and fixed interest for company B, but at a lower cost. So both of them knows some other bank C, which is called as swap bank. Okay. In practical life, it can be even bank A or bank B also, but I'm assuming a separate bank here, which is called as swap bank. The objective of this bank is to make sure that both company A and company B achieves their objective vis-a-vis cost savings. Now, swap bank says that, okay, because both the companies visit swap bank, now swap bank says that, okay, I have two things on my table. One, I have two options with me. This is how swap bank is analyzing the entire scenario. Only swap bank has that visibility, okay? Because company and company B don't have any connections. So company A don't know company B. Both of them goes to swap bank and swap bank analyzes it from two angles. One, if I ask A to borrow in fixed and B to borrow in floating, then what would be my rate? My rate will be 7% plus MIBOR plus 1%. So in totality, it will be MIBOR plus 8%. Correct? And option 2 is vice versa of option 1, which is floating for A and fixed for B. Floating for A is actually MIBOR only plus fixed for B is 10%. So it comes out to be MIBOR plus 10%. Okay, students, I think the discussion till now here is very clear. So there are two options that this swap bank has already analyzed, and it is contemplating that the cheapest option is option 1, in which the overall cost of borrowing comes as M plus 8 compared to option 2, where it comes as M plus 10. So it will say that, okay, I will ask company A to borrow in fixed and company B to borrow in floating. But that is where their treasury teams have a problem, because their treasury team says that my preference is to borrow in floating. Why are you asking me to borrow in fixed? Then swap bank will say, wait, I'm only asking you to borrow in fixed. I will convert your fixed loan to floating loan. That is up to me. I will do that. Similarly, company B also, swap bank says the same thing, that since your preference is fixed, I will make sure that you end up paying fixed rate of interest, but for the moment you borrow in floating for me. So that is what swap bank has a visibility. So basis the instructions from swap bank, company A, let's say, borrows 5 crore, and both of them are in need of the same amount. Okay. For the ease of understanding, I'm saying company A also needs 5 crore, company B also needs 5 crore. So company A takes a loan of 5 crore and it agrees to pay to bank A 7% as fixed amount, 7% as fixed rate of interest. So 7% would be paid here, and bank A has given a cash flow of 5 crore as loan to company A. Similarly, company B, bank B has given 5 crore, but company B will pay to bank B in the form of floating, which is MIBOR plus 1%. Now, swap bank says that, okay, since you have a preference, now swap bank says to company A, okay, swap bank pays it to company B. Okay. In turn, now company A says that I will pay 7% also to bank and I will pay MIBOR also to you. My effective interest rate is M plus 7%. This is very high. So swap bank will say again, wait, I am taking MIBOR from you, but I will pay you something fixed. Similarly, company B and Swap Bank also, they will say that Swap Bank say I am paying you MIBOR, but in return, I would want 8.25 percentage as the interest rate. So this is a swap happening. Floating of MIBOR is getting swapped with fixed of 8.25 percentage. And then Swap Bank will also pay fixed amount. Here Swap Bank is receiving fixed amount, right? In this case, here Swap Bank will pay fixed amount to company B of 7.75 percentage, 0.5 percentage, which is the difference between 8.25 and 7.25. Swap Bank will keep it with him as a commission of the swap, and ultimately the transaction is executed as a swap. Now, ultimately, what will happen? We will see it through the calculations. Okay. But you have understood what is the flow, how the flow will look like. Now, let's come here. After swap. After swap, what will happen? Company A. Let's see what all company A is paying and what all company A is receiving. So whatever is paying, I am circling it with red. Okay. And whatever it is receiving, I am circling it with green. Okay. So company A is paying MIBOR plus 7% and it is receiving 7.75 percentage. So this comes how much? MIBOR minus 0.75 percentage. This is the effective percentage that has come to company A. Now let's talk about company B. Now company B is actually paying this amount to bank, which is MIBOR plus 1%. It is also paying 8.25 to Swap Bank. And at the same time, it is receiving MIBOR. MIBOR plus 1% is the first payment. 8.25 fixed is the second payment minus MIBOR that it is receiving is the receipt. This will get cancelled. 8.25 plus 1 will become 9.25 percentage. Correct? This becomes how much? M plus 8.5 percentage. Correct, students? And if you reduce the commission charged by Swap Bank, this will come to the original cost of borrowing itself. So this is the M plus 8 percentage, which is the option 1 total cost that was coming, correct? If you see option 1, M plus 8%, that is how it is coming here. Any questions till now? With this, it covers your interest rate swap. I hope it was very easy to understand. So this is how the swap transactions work. Now you can imagine this not only for interest rates, but for anything. The concept remains same. So swap is I am exchanging something for something. Here the exchange is happening of floating and fixed and floating. But swap can be for anything else also. It can be for currencies also. I'm swapping USD for INR or I'm swapping INR for USD at different rates that are determined in the entire arrangement. Okay. All of you can note it down. I am showing this screen again. And now, if you see the last leg in this, okay, first all of you note it down, then I'll make you understand what is the last leg. So this is I am putting here if. So without swap, no swap and swap. Company A. For company A, if the entire swap arrangement is not there, then company A would have borrowed at MIBOR, correct? Because it wants to borrow, the preference is to borrow at floating. Company B would have borrowed at fixed, which is 10%. And swap bank, there is no cash flow here. This is MIBOR plus 10 percentage. With this, company A's effective borrowing cost comes out to how much? M minus 0.75. And after swap, companies B effective borrowing comes out as 9.25. And swap bank gets a income of 0.5. This is minus 0.5 because that is the income. So this is M plus 8 percentage. So the saving here is 0.75% for this bank, for this company A, 10 minus 9.25, 0.75 percentage for company B, and 0.5 percentage for swap bank A. Ultimately, this is the 2% saving that we are talking about. Okay. I hope this is understood. So Kaushik is saying, can we say that 2% is loss to bank? I would say collectively, yes. Collectively, bank A and bank B are at losses. Because collectively, if they would have also formed some sort of a swap, then they would have not ended up having this 2% loss. Yes, Kaushik, you're right. That 2% loss is now sitting with bank A and bank B. But practical consideration, there is one more thing. The swap bank here should be really cautious that company B would honor its commitments. Because if you see why company B was charged higher interest rate by bank B, because company B is a new company and there are chances that there is no proper debt service coverage ratio or interest service coverage ratio, because of which there is a risk of higher non-payment. And then swap bank should also take into account the higher risk of getting some sort of a default from company B. Okay. So I'm saying that is not where, we have some sort of implication, but practically I'm saying you that is a important point to be considered. So in a way, then what bank, the swap bank will say that, okay, I will pass on lesser savings. Let's say 0.60 only. And here I will pass on 0.90, something like this. I will charge higher amount from company B because company B is holding lower credit rating. Okay. So this is just a perspective that I'm giving. As of now, though, what Swap Bank has done, Swap Bank has equally distributed 1.5% between company A and company B as 0.75, 0.75. Okay. Perfect. Let's go to this. Okay, there is one more thing before going to this question that I want to, explain all of you. So there are two terms, and this I briefly touched upon yesterday. One is the overnight. Borrowing rate. Okay. So this is actually if you borrow for one night, then what is the interest rate? So one day / night, I'm saying whatever it is, what is the interest rate? Generally, this can also be expressed in percentage per annum. Okay. Generally, the interests for all the maturities are expressed in percentage per annum. Here, if I talk about 6 months, 3 months, this is higher maturity, correct? This is higher maturity. So this takes into account, this is also expressed in percentage per annum. This is also expressed in percentage annum. But let's say this is 2% per annum. This is 3% per annum. So the difference between these two is the risk. Because as I told you in my previous session, overnight borrowing rate assumes zero risk. Risk of non-payment, I'm saying. Zero risk of non-payment. Why? Because today you are investing for one day. You definitely know that the company in which you are investing will not go bankrupt over today itself. Correct? And or let's say the cash flows will not turn very bad over one day, so that tomorrow it is not able to service my obligation. But 6 months and 3 months, because of the higher maturity, or even let's say 1 year, 2 year, like that, there the risk is higher. Correct? Because there are chances that the company's performance might slip into the worst case, and hence the amount may not come back. So what people do, people always say, or let's say the experts always see this overnight borrowing rate as the riskless rate. Okay, as the riskless rate. And what they do, they generally swap this rate. So in my previous example, in my previous situation, I have said that MIBOR is getting swapped, okay, with 7.75 percentage. In this case, MIBOR is getting swapped with 8.25 percentage in this case, correct? So what people do is people do a OIS. This is called as overnight index swap. In this, they swap OIS with fixed percentage. Let's say OIS will keep on changing every day, right? The overnight interest index will keep on changing every day, but the fixed will remain fixed. So they will swap it against the fixed one, not with a, let's say, 3 months, 6 months kind of a rate with fixed. So this will happen only in case the maturity is 3 months or 6 months. We will do one question to understand it better, but I have just explained you this term. Overnight index swap is one form of swap which swaps the overnight index rate with fixed rate. Okay. And fixed here is the same 7.75 percentage or 8.25 percentage, but this will get swapped with the overnight index rate. Okay. Now let's go to next question. Question number 7. Suppose a dealer quotes all in costs for a generic swap. Now, there are different kinds of swap, or they will use different terminology, but generic swap, plain vanilla swap is just a simple swap which with no added complications. So what is this swap? 8% against 6 months LIBOR flat. Simple. This is not a OIS swap. This is not a OIS swap because they are using 6 months LIBOR as the benchmark rate. Correct? Had they used overnight rate, then it would be OIS swap. Instead of generic swap, it will become OIS swap in that case. Okay. If the notional principal amount of the swap is 5 lakh, calculates semi-annual fixed payment. So first of all, we need to understand what is this. Fixed interest rate is how much? 8%. Floating interest rate is how much? 6 months LIBOR. Correct? So 8% will be swapped against 6 months LIBOR. First of all, they're asking us to calculate the semi-annual fixed payments because it's a 6 month LIBOR. Again, I'm assuming that the settlement has to happen in 6 months. The maturity is 6 months here, correct? That will give an indication. So the first part, calculation of semi-annual fixed payment. 5 lakh. Plus they are also saying that use the convention of 30 by 360. Okay. So it is 6 months. We will say that it is 180. Okay, wait. Effective date of swap. So if you read second part, it says that find the first floating rate payment for above 6 months. The month from date swap settlement date comprises of 181 days. So it's better to take 181 days in this case. because somewhere question is indicating that the swap that you are computing is for 181 days. The effective period is 181 days. 8%. Okay. 8% is the fixed amount. So it comes as 20,111. So the semi-annual fixed payment is first part solved. Now let's read the second part again. Find the first floating rate payment for one above. So they are asking us to calculate now the floating rate payment. If the 6 months period from the effective date of swap to the settlement date comprises 181 days, which is fine, which is what we understand that swap is for 6 months and hence they're asking us to use 181 days. And the corresponding LIBOR was 6% on the effective date of swap. So they are saying that the LIBOR was 6% when it was agreed, and 6% has been agreed against 8%, correct? So let's calculate the floating rate payment. Now floating rate is at 6% for 5 lakh notional amount, 181 days divided by 360. 15,083 is the amount. So this is the floating rate. 15,083. Then finally net payment would be equal to, because in the last part, it is also asking us to calculate. In second above, the settlement is on net basis. The settlement is not happening on gross basis, it is happening on net basis. How much the fixed rate payer would pay to the floating rate payer? Why it is saying that fixed rate payer has to pay? Because fixed rate payer has 8%, floating rate payer has 6%. So there is a net benefit to the floating rate payer, and there is a net loss of 2% to the fixed rate payer. So ultimately, fixed rate payer will pay 20. The difference between these two basically, 111 minus 15,083, which is equal to 5028. So the net payment to be done is 5028. Okay, students. So all of you can note it down till here. Yeah. So let's break for 10 minutes. It's 8:25 now. Let's again reconvene at 8:35. Hello, can I start now? Okay, yeah. So welcome back, students. So we'll come to the last part of this session in which we discussed about swap. So swap was the last topic just to study. Then now we will actually practice some of the questions to understand it better. And then finally we will revise all the concepts at last. And if anyone of you have any queries, then please post related to the topics that we have covered in today's and the previous session. Okay, I would be happy to take it up. Yes, this is question number 8 now. Perfect. This says that derivative bank, so the bank is itself derivative only, entered into a plain vanilla swap through an OIS, overnight index swap. Okay, I think most of you now know what this term means. So one night index rate swapped with fixed rate. This is what is called as overnight index swap. On a principal of rupees 100 crores and agreed to receive MIBOR overnight floating rate. See, so here they are receiving MIBOR overnight floating rate on receive 100 crore for a fixed payment. Now, what is this derivative bank doing? This derivative bank is actually receiving overnight rate and it is paying. So M means MIBOR. Let me put the entire term. MIBOR overnight rate it will receive and it will pay what? It will pay fixed payment to the other party. This is the counterparty, other counter party. Okay, I hope this is clear. The swap was entered into on Monday, 2nd of August 2010 and was to commence from 3rd August 2010. So they have entered into swap on Monday, but the actual execution will happen next day, which is Tuesday, and run for 7 periods. It was for 7 days. Respective MIBOR rates for Tuesday to Monday were Tuesday, Wednesday, Thursday, Friday, Saturday, and then again Monday. Sunday they have not given. So ultimately 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. Ultimately 6 rates they have given on a daily basis except for Sunday because Sunday is assumed to be a holiday. If derivative bank receives 317 on net settlement, calculate fixed rate and interest under the both legs. So now this question is a bit tricky because this question is not asking you to calculate the net settlement amount between fixed and floating. They have already given you and they have also equipped you to calculate the floating rate because they have given you the day-wise floating rate. Using that, we can calculate the fixed rate. Okay. They are saying that Sunday is a holiday that we have already also seen because the rates are given only for 6 days. And the next point, which is work in rounded rupees and avoid decimal working. Okay, students. Now, first of all, if the bank is receiving overnight rate and paying fixed. That means floating is higher than fixed, because ultimately it is mentioned that bank received 317 on net settlement. Correct? Because it is mentioned here, right? Received 317. That means floating is higher than fixed. If we have to calculate fixed, what we just simply need to do, floating minus 317 is what we can do. Fixed payments, floating payments, minus 317 would be equal to fixed payments. Correct? This is a simple equation. This will help us in calculating the fixed payments. Now let's calculate the floating payments. Step 1. Calculation of floating interest payments. Okay. Let's plot days, outstanding amount, MIBOR percentage, and finally interest. Now students, please note that there are two things that we need to understand for calculating the floating rate payments also. Assume compounding. So there are two ways, right? One is that we can just simply take, what is the amount? 10 crore, 10 crore, 10 crore, 10 crore every day and calculate the interest on that. But that would be wrong, because it's that you are investing for 7 days and the daily rate keeps on changing. So the compounding will happen on daily basis. Compounding daily. This is the first. And second one is, you have to take this factor also, 1 by 365 for 1 day. But for Saturday, money will be kept for 2 days, right? Saturday and Sunday. So in that case, you will have to take 2 by 365. This for regular days, but for Saturday, this much you have to take. So just be cautious over here, because sometimes we might not do compounding, or sometimes we might not think that Sunday also needs to be added. Now, the reason why Sunday we are adding, because still the funds are being utilized. The bank also don't say like to you, if you take a loan, that okay, I will charge only for working days from you. I will not charge for Sundays. I will charge for Sundays. But since the market is closed, the rate cannot be determined for Sunday. Whatever rate is applicable of Saturday will apply on Sunday also. Okay. So let's put all the days here. Tuesday is the first day from when the deal will be executed. Outstanding amount, let's assume on Tuesday, the amount has been drawn, which is the notional amount, which is 10 crores. MIBOR on the first day is given as 7.75. Let me see if there are any questions. No, there are no questions. Students, please, again, I am asking. If there are any questions, then please post them. So the interest here, it will be calculated how? 10 crore multiplied by 7.75 percentage, 1 divided by 365. Okay. This comes to how much? To 1,233. Yes. Then comes Wednesday. So this is the interest for Tuesday, correct? Since I said that compounding on a daily basis, the Wednesday interest will not be calculated on 10 lakh, but on 10 crore, 10 crore plus 21,233, which is the interest for Tuesday, which means daily compounding is happening. 10 crore, 21,233. Now, what is the rate appearing on Wednesday? Wednesday is 8.15. Again, we have to take 1 divided by 365 also as a multiplication factor. So the amount comes as 22,334. 22,334. Okay. Then for Thursday, the amount will again get added in the principal. So 10 crore 21,233 plus 22,334 comes as 10 crore 43,567. Okay, 10 crore 43,567. Now on Thursday, what is the rate? 8.12. 22,256. Now again for Friday, this 22,256 will get added in the Thursday's amount. So that will become 10 crore 65,823. 7.95 percentage is the MIBOR on Friday. That takes 21,795 as the amount of interest for Friday. Then let's keep Saturday and Sunday. 10 crore 87,618 is the amount. And for Saturday, what is the rate? 7.98. Here, students, please remember we have to take 2 by 365 because there are 2 days. So we have to multiply. Let me write the formula here itself. 10,087,618 multiplied by 2 divided by 365 multiplied by 7.98 percentage. If you solve this, 87,618 multiplied by 7.98 percentage multiplied by 2 divided by 365. So this comes as 43,764. Then lastly on Monday, 10,01 31, 382, 8.15 percentage, 22, 358. Uh, Student, just give me 1 minute. I'll just be back. Just give me 1 minute. Yeah. So, so the last interest on Monday comes out to be 22,358. And if I take a total here, so this question is really calculation intensive. Perfect. Yeah. So the total floating interest rate comes out to 153,740. Clear till now? Now, using our previous discussion here, we concluded that for calculating the fixed payment, we can just take the floating payment and reduce 317 from that. We will get the fixed payment. Because floating payment is higher, correct? And on a net basis, the dealer has received 317. Fixed payment is equal to floating payment minus 317. So the fixed payment turns out to be 153,740 minus 317, which is actually equal to the fixed payment of 153,423. And if we calculate this as a percentage, so we are doing into 365 by 7 because it's for 7 days. The interest is for 7 days. Per annum interest comes out to 8%. Okay, so this was the question on overnight index swap. Somewhat, some basic assumptions need to be made, and some of the very basic, thoughts, which is, let's say, for two, when you have to take for 2 days, when you have to take for 1 day, like that. Actually, if we see this fixed interest of 8%, also the way it is calculated is assumed that there is no daily compounding. Correct? The way this is calculated is wrong. But this is just an indicative number that has been calculated because the assumption is there is no daily compounding basis this 8%. If there is a daily compounding, then definitely 8% would be higher. Okay. Sorry. Yeah. Now let's come to question number 9. A Inc. and B Inc. intend to borrow $2 lakh and $2 lakh in yen respectively for a time horizon of 1 year. So they are saying that there are two companies, A and B. A wants to borrow in dollars and B wants to borrow in preference in dollars. Preference in yen. Yes, this is what is mentioned. The prevalent interest rates. So for both the companies, they have given both for dollar as well as the yen loan. The prevailing exchange rate is $1 is equal to 120 yen. This is also given. Now see students, they are entering into a currency swap under which it is agreed that B will pay a 1%. So B will pay to A 1% over the yen loan interest rate, which the later have to pay as a result of the agreed currency swap. Later here means A. So the arrangement is that B will pay 1% higher to what A is supposed to pay as per the agreed currency swap. Now, what is the agreed currency swap? We don't know till now. Correct. But whatever is the currency swap, in that B will pay to A 1% over and above what A is supposed to pay as a result of agreed currency swap. Okay, so 1% plus I have mentioned till now here. Whereas A Inc. will reimburse the interest to B Inc. only to the extent of 9%. This is what they have given. This is 9% reimbursement. But still this amount is not clear, right? 1% plus what? Keeping the exchange rate invariant. So they are saying exchange rate, you can keep it as invariant because we're talking about a time horizon of 1 year. So whatever is today's exchange rate, can there be 1 year from today's exchange rate also? So there is no change. That's what they are trying to say. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. Now, the question has still now not told us what is the currency swap. We will use the same discussion that we did for the swaps. So there are two options for designing the currency swap. Option 1, that A lets borrow in dollars, B borrows in yen. So this is A for dollar is 9%, B is 8%. (9% plus 8%), correct? Which is equal to 17%. 9 plus 8, 17. Option 2. Under option 2, let A borrow under yen and B borrow under dollars. Ultimately, A will end up paying 5% and B will end up paying 10%. So the cost of the collective cost of this borrowing will become 5 plus 10, 15%. Correct? These are the only two options possible. What has happened here? Whether option 1 is feasible or option 2 is feasible. Definitely option 2 is feasible. is better because there is a 2% saving. Option 2 is leading to the most optimum borrowing cost, and hence the same should be used as designed currency swap. As a result, following swap payments are agreed. A would pay to B 9%, correct? This is fixed, right? 9% is fixed. B would pay to A 1% plus. Now let's go back to that line and understand 1% over the yen loan, that interest rate which the later will have to pay as a result of agreed currency swap. As per our option 2, we are also saying that A should borrow in yen, which is 5%. So over and above 5%, 1% will be paid extra. I hope this is clear. So the resultant amount is 6%. Okay. So just to plot it, A, B, and here is the swap. So A will take a loan in yen. There is a swap that will happen, and B will borrow in dollars. Correct? So what will A pay? A will pay 5% here. B will pay 10% here. Now A will pay to B 9%, and it will receive how much? 6%. B will pay to A 6%, and B will receive how much? 9%. Minus 9. Yes. This is what the final equation is. Now let's calculate the overall cost, or let's say overall opportunity gain or loss. Okay, so this chart I've just put it so that it is very clear. So here it is 10 plus 6, 16 minus 9 is 16 minus 9 is 7% effective cost. And here it is 5 plus 9, 14 minus 6, 8% effective cost. 8 plus 7 is equal to 15%. Okay. And if they have not entered into swap, then A would have ended up paying 9 and B would have ended up paying 8. 9, 8. If the swap is not entered. Okay. So there is a benefit of 1% to both the parties. Now let's calculate the amount that they are all going to save. So first let's put opportunity gain slash loss This is from A Inc.'s perspective, and we are doing workings in dollars. Okay, because A has a preference to take in dollars, and hence we are doing working in dollars. So the first part is interest to be remitted to B. So interest would be remitted to B at the rate 9%, $2 lakh, 9% for 1 year. Correct? This comes to $18,000. Simple. Then interest to be paid to bank for yen borrowings. What is the interest rate that will be paid to bank? So it will borrow in 2 lakh USD will become how much? 2 lakh into 120, right? 24 million yens. So it will borrow 24 million yens. On that, it will end up paying how much? 5%, right? A will end up paying 5% on 24 million. But since we are doing calculation in dollars, hence we will take 1 divided by 120 to convert this amount into dollars. Okay. This is 10,000. And finally, so this is 1, this is 2, this is 3. So this is interest to be received from B. So this is 2 lakh USDs, right? On 2 lakh USD, it will receive 6% for 1 year. So this becomes 12,000. So how much it is? 18 plus 10, 28 minus 12, $16,000. Interest cost under swap is $16,000. So this is the interest cost under swap. If swap has been entered, this is going to be the interest cost. What if the swap is not entered? Then without swap, $2 lakh would have been borrowed, and it would have been borrowed using the dollar rate. What is the dollar rate? For A, what is the dollar rate? 9%. For 1 year. $18,000. So there is an opportunity gain of $2,000. This is from the perspective of A, all these calculations that we have done. Now let us do the calculations from the perspective of B. Opportunity gain slash loss B's perspective, and this let us do the calculation in yen because the preferred currency is in yen as it was mentioned, correct? So first of all, B, to pay interest to A, 24 million. On that, B has agreed to pay 6% for 1 year. So this is 14.40 lakhs. So this is essentially 1.44 million. Okay. B to pay interest to bank. Now, in which currency B has taken a loan? B has taken a loan in dollars. So $2 lakh. What is the exchange rate? Oh, sorry, what is the interest rate? B would have to pay 10% on the loan for 1 year. But since we are doing the calculation in yen, we will multiply this by 120. That is the exchange rate to arrive at the yen amount. So this comes as 2.4 million. Then the third cash flow. This is the first, second, third. B to receive interest from A. That will be how much? On 24 million, B would end up receiving 9% from A. Correct? Two one six zero triple zero. This is the amount that B will receive, and hence net amount will become 1680,000. This is the net interest under swap. Preference of B was to borrow in yen. So for B, the yen's rate applicable is 8%. Correct? $19.20. The net opportunity gain on account of swap is 2,40,000, which is 1% of the loan amount. And here also it was 1% of the loan amount. So this is 1%. This is also 1%. So meanwhile, students, you note it down. Are there any other questions that are coming to your mind? Because we are left with the last question. With that, we will be through. I can understand today is a Sunday morning and hence most of you would be in that zone. But let me tell you that all these topics are very relevant and too much used in the practical life too. If there are no queries, so then we can uh, go further. So this is the last question of the session. Then for another 15-20 minutes, we will just quickly take a revision of the entire thing that we have studied and then we will wrap it up. Question number 10. A textile manufacturer has taken floating interest rate loan of rupees 40 lakhs on 1st of April 2012. 1st April 2012, the loan amount is 40 lakhs. The rate of interest at the inception of loan is 8.5% per annum. And please don't forget, students, this is a floating interest rate loan. And that is why there is a need of interest rate risk management. If the loan itself is taken at a fixed rate, then there is no need of interest rate risk management. The rate of interest at the inception of loan is 8.5% per annum. Interest is to be paid every year on 31st March. Okay. So 31st March, the interest needs to be paid and the duration of loan is 4 years. 2, 3, and 4. 1, 2, 3, and 4. These are the 4 years completed here. Okay, students. In the month of October 2012, the Central Bank of the country releases the following projections about the interest rates likely to prevail in future. So somewhere here, October 12, they releases that what would be the likely interest rates that are going to come in future, which is, let's say they said that 8.75. Then they said that 31st March would be 10%, then 10.5%, then 7.75%. Show how borrowing can hedge the risk arising out of the expected rise in the rate of interests when he wants to peg his interest cost at 8.5% per annum. Students, the question is itself saying that maximum they should pay is 8.5% per annum, and how it can hedge because the interest rates is keeping on increasing. Only last year it is decreasing, right? Then in the second case, it is also saying that assume that the premium negotiated and there is one more indication here which says that when he wants to peg his interest cost, right? Peg means limit his interest cost, which is at 8.5. That means they're talking about interest rate guarantees. And it is clearly evident in the second part when we read it, assume that the premium negotiated by both the parties is 0.75% to be paid on 1st October 2012. So here they've agreed that 0.75% let's pay premium and let's take a interest rate guarantee, which is a cap option. And they have also given you the actual rate of interest on the respective due dates. 31st March, 10.2, then next. So let me put here actual interest rate. 10.2, 11.5, 9.25, 8.25. Correct? Show how the settlement will be executed on the prospective interest due dates. Prospectively, on the respective interest due dates, how the settlement will happen. It's very simple. So we have been given that there is some strike rate, premium payment, all those things. So let's start. First of all, in October 2022, the premium would be paid. How much is the premium? 0.75% for 40 lakhs, which is the notional amount. 30,000 cash outflow, right? Because the textile manufacturer has to spend 30,000 as cash outflow in the form of premium. Then comes March 23, first interest settlement date. And please see that the settlement is happening after every 1 year, correct? So what is the actual interest rate there? 10.2. Textile manufacturer has an option to borrow at 8.5%. The actual market interest rate is 10.2. So the textile manufacturer will exercise this option of borrowing at a lower rate, and hence the net adjustment, or let's the net settlement, will happen basis the difference between these two on 40 lakhs for 1 year. This will give us 68,000 as cash inflow. So here we can say that received by manufacturer from option exercised. Because just to again reflect on the knowledge of derivatives, this is in the money option, correct? Because it is in the money, it will give benefit to the holder. Then comes March 24. Sorry, I have actually written here wrong. It's not March 23. It's October 12 actually. Sorry. I advanced these by 10 years, the current period where we are. This is March 13, March 14. So March 14, the interest has gone even higher, which is 11.5. So still the textile manufacturer will exercise the option. How much it was? 11.5 for 1 year. This comes as 1,20,000. Then comes March 15. March 15, what is the interest rate? Interest rate is 9.25. Our strike rate is 8.5. Still it is higher. So the conditions are still favorable as on March 15, and the dealer will end up, the textile manufacturer will end up exercising the option because it is still in the money. 30,000, yes. This is again received by textile manufacturer. This is also received by textile manufacturer. Now, last date, which is March 16. Now, what is happening in March 16? The textile manufacturer has an option to borrow at 8.5, but open market is giving at 8.25 percentage. So don't you think the textile manufacturer will not exercise the option because market credit is cheaper at 8.25 percentage. So there is no settlement in this case that is going to happen. So with this, we actually complete the topic of interest rate risk management. Now let's take a quick revision of whatever we studied between today's and the previous session, just to cover up the entire. Uh, yeah. So students, now we are actually revising whatever we have studied. So first of all, for interest rate risk management, we studied that why there is a need for interest. And while we found out there are two reasons, one is risk of non-payment and second is inflation slash time value of money. The risk of non-payment is generally governed by the ability of the borrower to repay interest as well as debt. In case it is not there, then the interest charge is higher, that we have even seen in the practical questions. And generally, this is governed by the credit rating agencies, that what is the risk, or let's say what is the credit worthiness of the person to whom you are lending. Inflation is again time value of money, that we understood that the there are different value of the same, one basket of goods today is 100 and 1 year hence it would be 120. That is what is time value of money. Then we also said that interest is always dynamic. Interest is never static because there are different interest rate cycles in an economy, because of which central bank takes a lot of decisions whether to increase or decrease the interest rates. Similarly, interest is also an outcome of demand and supply. If demand is higher of loan as compared to supply, interest rates will go up. So hence interest rate is dynamic. And there are certain benchmarks that we studied, MIBOR, SOFR, LIBOR. LIBOR, we said that it is now abolished. So this is all what we studied. Then we also studied that what impact will and changes in interest rate will have on the balance sheet and P&L, which is a micro level impact. Then we also studied that what are different types of interest rate risks. In this, the very, very important part was on the gap exposure, because here we understood that there are some assets and there are some liabilities which are related to floating interest rates. Those are called as interest rate sensitive assets and interest rate sensitive liabilities. Then we said that there is an impact on net interest income. After we identify what are the interest rate sensitive assets and liabilities, we calculate the gap. If gap is positive, that means assets are higher than liabilities, then NII will be positive on interest rate increase, and hence there is a direct proportion. If gap is negative, then NII will have a inverse impact, inverse relationship with interest. Then second, we studied about basis risk. So gap exposure or gap risk is the risk of gap between assets and liabilities. Basis risk is the risk that if benchmark rate increases or decreases by 1%, it is not necessary that all your assets and all your liabilities which are linked to the floating interest rate will also increase or decrease by 1%. That means the magnitude of change in the actual asset or liabilities related interest will be different to what the benchmark rate is. This is called as basis risk. We studied about embedded option risk. Embedded option we understood through an embedded instrument called as callable bond, which we said is having two features. One, it is a straight bond, plus there is a call option with the issuer to call back the bonds at any point of time. And if the bond is called back, then the risk of earning interest loses out, and hence it is a types of interest change, interest risk. Basically, that is one of the type. Then we also studied about yield curve risk. Yield curve for any investment is denoted by interest rate on y-axis and maturity on x-axis. And it denotes when maturity increases, interest rate also increases. If it is like this, if it is a negatively sloped graph, that means that higher maturity people are expecting of that economy, that the interest rates would be lower. Higher maturity, lower interest rates, lower maturity, higher interest rates. This is an indication of recession because the spread is negative. Then we studied about price risk. Price risk is where the bonds prices have an inverse relationship with the interest rate changes. And if they have inverse relationship, then the prices of the bonds will also influence the yields that are getting generated in the form of interest rates. And vice versa also is true. Reinvestment risk. So once we are planning to reinvest our amount after 1 year, then what rate we would get is again a type of interest rate risk. Net interest position risk. In this, we studied that the same principle that we have studied in gap exposure, if the assets is greater than liabilities, then there is a positive relationship. If the liabilities are greater than asset, then there is a negative relationship between the interest rate and the net interest income. Then we studied that what are the different techniques to hedge interest rate risks. One, there are these traditional methods, and second, there are these modern methods. This is clubbed into two buckets. Traditional methods, we studied asset and liability method, ALM, asset and liability mismatch. If it occurs, it will lead to differences in the timing of cash flows. So we studied that under this technique, the timing of the cash flows of realization of assets and payment of liabilities has to be matched. In this case, it is matched, then we will be able to minimize the impact on our balance sheet and profit and loss account on account of the interest rate changes. We also studied about forward rate agreements. So let's go to forward rate agreements. We said that in forward rate agreements, the agreement is to borrow or lend not today, but in future. And that too, in future, it will happen at the rate that is specified, which is a forward rate. Then we studied the naming convention of FRA. FRA 3/9 means that it will be executed on the third month from now, and the tenure will be 6 months. Then we studied the different payoffs between both the parties under FRA. Who will gain, who will lose will depend that who have taken what position. Important point to note here is if the person who is borrowing is always in the position of purchasing that FRA, that is a long position. And if interest rate goes up, there will be a gain. If it goes down, there will be a loss. Similarly, bank B, who is a lender, is always seen from the selling FRA, which is a short position. And hence, interest rate goes down is a gain and interest rate goes up is a loss. We did some good questions on this. Then we also studied about the valuation, how to value the FRA along with the hedging techniques. Then this was again important part, which is interest rate futures. In this, we said that we will use this relationship between bonds price and interest rate changes, that is the inverse relationship, to hedge against the changes in interest rate. And we said that we will take the opposite position in the bonds market. If the interest rate goes up, if we are hedging for interest rate going up, we will hedge for the bonds prices going down. Similarly, if we are hedging for interest rate going down, we will cover for the bond prices going up. We have done some questions on this. Then we came to the today's session, which is interest rate options or guarantees. Here we said that these are the different options available, which are two types of options we studied. One is the cap option and one is the floor option. Okay. Cap option, we said that it is for those people who want to borrow and it will put a cap on the amount, on the interest that would be paid. That is a cap option. Floor option is for the people who wants to invest, and it will act as a guarantee on the minimum payment that is required to be paid. So as an investor, the minimum expectation I can have at least on the floor option price. Then we studied about this very relevant topic of swaps, in which we studied how the swaps are designed, how the transactions are settled, and fixed versus floating, floating versus fixed, plain vanilla swap, OIS swap, all those things we have studied. And we also studied that how we can make a analysis about which option is better and which option is not between both the swaps. So I think that's all. Some of the important pointers that we have discussed during the discussion, I would suggest that all of you should actually keep them. And just to, on the revision part, just do revision of this topic at least 3 to 4 times so that the entire understanding and the entire, question solving part is very clear to all of you. So this is all from my end. Is there any other thing that I can help with you? Please do post in our query handle. Otherwise, we will end up the session. Thank you, Sanjay. So yeah, I think there is nothing else. There are no further queries. So yeah, we can wrap up today's session. Have a wonderful day ahead and all the best for your upcoming, preparations and examinations. Thank you. Technical team session over.